The debt ceiling fight isn't anything new. We've been hearing about it every couple of years. But this time, it could be a little bit different. It could threaten a popular corner of the market, which is typically considered safe. We're talking about Treasury bills, which have gained in popularity over the last 2 years thanks to higher yields. But without a new debt ceiling deal, yields could plummet, and that could hurt investors. T-bills are a kind of debt the U.S. auctions to investors at home and abroad. They mature in a year or less and are considered one of the world's safest investments. T-bills are a cash equivalent. That means traditionally they're as safe as keeping your money in a bank account, but with the added bonus of a little bit more yield. Money market funds are also a cash equivalent, and they have about $7 trillion in assets, making them a huge part of the buyer market. When interest rates were ultra low, Treasury bills offered meager yields. But in 2022, Treasury bills started offering historically high yields because the Federal Reserve was raising interest rates. For example, if we look at this chart of 3-month Treasury bill yields, you can see that they have been offering 4 to 5%, which is really high for this asset. So naturally, Treasury bills have gained in popularity, especially with households. As you can see from this chart, households own almost $3 trillion in treasuries, and that's up from less than $1 trillion just a couple years ago. That's partly because the U.S. has been issuing more bills and expanding its debt load. But what would happen if the U.S. government isn't able to raise the debt ceiling or freeze it temporarily as it did in 2023? Well, we can see from this chart that Treasury bill issuance drops when there's a debt ceiling fight ongoing. During the periods highlighted, the government was operating under extraordinary measures. That's when the government isn't relying on Treasury bill funding, but has to look to other pockets of money or reserves to fund itself while Washington works on a debt ceiling deal. A supply constraint means it's harder for people to get their hands on Treasury bills. As a result, there could be more demand than supply, which would push Treasury bill prices up and yields down. So what's ahead for people investing in T-bills? On the one hand, the Federal Reserve is expected to keep interest rates roughly where they are now, which would be good for investors in T-bills because the yields would stay higher for longer. For now, the debt ceiling fight is a wild card. Wall Street thinks it could drag on into the summer. And that could mean investors get paid less to lend to the U.S. government and lower yields in money market funds.